All right, let's talk about investment funds. It's one of those topics that can feel super complicated, but I promise it's not. We're going to break it all down, make it simple, and help you feel way more confident about where your money's going. So, you've heard all the jargon, right? Mutual funds, index funds, ETFs. They get thrown around all the time, and honestly, they can start to blur together. What's the actual difference? Well, that's exactly what we're going to clear up right now. And look, we're not going to waste your time. This isn't some boring lecture. We're going to get this done fast. In just the next few minutes, you are going to get it. You'll have the key ideas down cold. So let's start with the big idea behind all of this. Before we start comparing and contrasting, we have to answer a really basic question. What even is a fund? And the idea behind it is actually incredibly simple. It all comes down to strength in numbers. Think of it like this. Imagine you're throwing a party, but you've only got enough cash for one pizza. If that pizza is, a total disaster, your party's kind of sunk. High risk. But what if you and three friends all chip in? Now you've got enough money for four different pizzas. Even if one of them is terrible, you've still got three other great ones to choose from. That is exactly what a fund is. It's just a giant pool of money from thousands of people, all put together to buy hundreds of different investments. It's all about spreading out the risk. Okay, so now that we get the whole pizza party concept, let's meet the main players in the game. We're going to look at the four big ones you'll hear about most often. And honestly, the best way to remember these is with some simple food analogies. Think of a mutual fund as a fancy professional chef, actively picking ingredients to create the perfect dish. An index fund, that's your all-you-can-eat buffet. It just gives you a little bit of everything on the menu. An ETF is like a flexible food truck. Great stuff, and you can get it whenever you want. And a hedge fund? Well, that's the super exclusive private chef for the really, really wealthy. Let's break them down one by one. So first up, we've got the mutual fund, our professional chef. These are run by actual managers, people whose entire job is to pick what they think are winning stocks and bonds. They're actively trying to beat the market. But that professional service costs money, which is why their fees are higher. They also tend to have higher minimums to get started. And here's a key detail. You can only buy or sell them once a day after the market closes. Now for the all-you-can-eat buffet, the index fund. This is pretty much the total opposite. It's what we call passive. There's no chef in the kitchen. Instead, the fund just automatically buys all the stocks in a major market index, like the S&P 500. And because there's no expensive manager making decisions, the fees are incredibly low. You get that instant pizza party diversification, but just like a mutual fund, you can only trade it once per day. Okay, this brings us to the ETF, our flexible food truck. Now, an ETF is like a hybrid. It takes the best part of an index fund, that low-cost, passive, buy-everything approach, and then it adds the flexibility of a stock. That means you can buy or sell shares anytime you want during the day, just like you would with Apple or Amazon. The minimum is usually just the price of a single share. So, what's the catch? Well, that very flexibility can sometimes tempt people to trade too much, buying and selling on emotion, which almost always hurts your returns in the long run. And finally, we have the exclusive private chef, the hedge fund. Yeah, this one's in a totally different league. It's not for most of us. It's only open to very wealthy or accredited investors. We're talking minimum investments of hundreds of thousands or even millions of dollars. They use really aggressive, high-risk strategies and have this infamous 2 in 20 fee structure, where they charge you 2% of your money every year plus 20% of any profits. Sure, the potential for huge gains is there, but so is the risk of absolutely massive losses. Okay, so we know what they are, we get the analogies, but here's the billion-dollar question, right? Who actually wins? Which one performs better over time? You think that paying for the expensive professional chef would get you better results, but the data tells a very, very different story. Get ready for this, because it's pretty wild. Over pretty much any long stretch of time, say 10 or 15 years, the vast majority of those highly paid professional fund managers fail to do the one thing they're paid to do: beat the plain, boring, cheap market average. The numbers are just staggering. When you look at the data, it shows that about 85% of the time, you would have made more money by just buying a simple, passive index fund and doing nothing. So, why? Why does the expensive pro lose so often? It really comes down to one big bad villain: fees. See, those little percentage points for fees, they don't seem like a big deal. 1%, 1.5%, but over decades of investing, they act like a termite, just silently eating away at your returns. Let me show you how massive the difference can be. So let's say you invest $10,000 and just leave it alone for 30 years. In that high-fee active fund, it grows to about 66 grand. Hey, not bad. But in the super low-fee index fund, that exact same $10,000 grows to almost $100,000. Same money, same time, just a totally different outcome. That is over $33,000 more in your pocket. That's not pocket change. That's a new car. That's a down payment. That is a life-changing amount of money that you get to keep simply by choosing the low-cost option. All right, we have covered a ton of ground here, I know. So let's boil it all down to the final verdict, the one simple takeaway you need to remember. So, which one is right for you? Well, a mutual fund could be for someone who really wants an active manager and is okay with paying for it. An index fund is perfect for the long-term, set-it-and-forget-it investor who wants to keep costs super low. An ETF is for that same kind of investor, but someone who also wants the flexibility to trade during the day. And hedge funds? That's a whole other world, a high-stakes game for the ultra-wealthy. So what's the bottom line in all this? For the vast, vast majority of us regular people, the evidence is overwhelming. Keeping it simple and keeping your costs dirt cheap with a broad market index fund or an ETF, that has been the most reliable and effective path to building real wealth over time. And so that really just leaves one final question. Now that you know the difference, now that you see how powerful things like fees can be, what's the smartest first step you're going to take for your money?